Hello, everyone, and welcome to another edition of For Our Financials Financial Forum. As usual, we'll have our three segments: Markets in Motion, Finance in Focus, and then our Wealth Wisdom Workshop. And this week, we're starting with inflation as our topic for the pre-retirees and retirees' major concerns. So let's get right into it. It was a week that showcased both the resilience of the market and the continued dominance of AI and trade. Despite all the geopolitical tensions, renewed uncertainty around Federal Reserve policy, and a sharp midweek sell-off, stocks ultimately finished higher in what can best be described as a V-shaped recovery, kind of like COVID. So for the week, the S&P 500 gained 1.23%, while the Nasdaq Composite rose 1.74%, and that was driven largely by strength in technology and semiconductor stocks. The Dow Jones Industrial Average slipped a little bit, 0.5%, and overseas developed markets struggled with the index falling 1.42%. The week started on a positive note as investors put aside some of the valuation concerns that had weighed on AI related stocks in recent weeks. Confidence returned to the technology sector, though, helping lift that NASDAQ more than 1% early in the week, while the Dow continued its strong run by reaching another record close and setting a new intraday high on Tuesday. Markets stumbled Tuesday and Wednesday as investors contended with renewed conflict in the Middle East and broader uncertainty about the economic outlook. Major indexes fell through Wednesday afternoon, creating concerns that the market's recent rally might finally be losing some steam. But the turning point came from semiconductor stocks. Chip makers rebounded strongly, helping the Nasdaq finish Wednesday with a modest gain despite broader market weaknesses. That recovery gained momentum over the final two trading days of the week, with technology shares leading a broad-based rally higher. Investors appeared willing to look beyond these geopolitical concerns, including the ongoing tensions in the Middle East. While reports suggesting diplomatic efforts between the United States and Iran may resume, help ease some of that investor anxiety. By Friday, though, several of the market's largest technology companies were driving gains again, pushing both the S&P 500 and the Nasdaq up more than 1% to close the week on a strong note. So while equity markets were focused on earnings potential and the AI story, investors were also carefully digesting new insight from the Federal Reserve. On Wednesday, minutes from the Fed's June meeting revealed a central bank still very much divided on the path forward for interest rates. Policymakers expressed differing views on how restrictive monetary policy should remain and whether inflation has cooled enough to justify future rate cuts. So Fed Chair Kevin Warsh characterized the debate as something of a family fight, highlighting the range of opinions among the policymakers. More importantly, the chair offered little indication about where the next decision may be heading, emphasizing instead that future actions will depend heavily on incoming economic data. So, in short, the Fed remains data dependent and inflation continues to be the central focus. That brings us to the week ahead, which features several key economic reports that could influence both market sentiment and expectations for monetary policy. So on Monday, investors will receive the Treasury Balance Report. Tuesday brings the Small Business Optimism Index, along with the Consumer Price Index, one of the market's most closely watched measures of inflation. Wednesday's calendar includes the Producer Price Index and personal consumption data, providing additional insight into pricing pressures across the economy. Thursday is particularly busy with reports on retail sales, weekly jobless claims, manufacturing and trade, inventories and sales, the housing market index, and pending home sales. Then on Friday, investors will be watching housing starts, import prices, industrial production, capacity utilization figures to round out a data heavy week. As we look ahead, the market's message remains clear. Investors continue to reward companies at the forefront of artificial intelligence and technological innovation, while remaining highly sensitive to inflation data and any signals coming from the Federal Reserve. The coming week's economic reports will determine whether the market can build on this latest rally or whether volatility returns as investors reassess the outlook for growth, inflation, and interest rates. That's your Markets in Motion update, and I will send it over to Jeffrey for Finance in Focus.
Yeah. So let's start with geopolitics and energy today, where headlines kind of remain complicated. So on the positive side, the U.S. and Iran are continuing talks with mediators, working to keep tensions from escalating. The White House continues to signal that it's focused on a diplomatic solution, which was help prevent um, a larger risk off reaction in markets. That backdrop matters because energy markets are already facing challenges. The International Energy Agency is warning that disruptions to refining capacity in both the Gulf and Russia could create shortages in gasoline and diesel, just as demand remains strong. So while diplomacy is helping contain immediate fears, energy remains one of the biggest potential sources of inflation pressure in the months ahead. What does it mean for clients? Markets are continually pricing a de-escalation rather than escalation, but the energy remains a key risk. And disruption to supply chain capacity could quickly push fuel prices higher and reignite inflation concerns. On the AI front, Meta is increasingly emerging as a strongest challenger to what has largely been a two-horse race between at the frontier model level. Meanwhile, competition continues to intensify with reports that SpaceX owned Cursor is developing an AI agent to compete with Anthropic's offerings. Beyond AI, we're seeing companies look for new ways to deepen engagement. Netflix is exploring live TV and bundled offerings to keep subscribers in its ecosystem. Prediction markets continue moving toward the mainstream, with Polymarket pursuing approval for margin trading, even as Goldman Sachs tightens restrictions on employee participation. And so, what this means for our clients is that AI themes remain very much intact, but it's becoming broader and more competitive rather than focus on um, a, head, a handful of headline names. Investors are finding opportunity to cross chips, infrastructure, software, and digital platforms that support the ecosystem. Finally, a few notable developments across industrials, consumers, and financial markets. Boeing appears close to clearing another important regulatory hurdle, with U.S. Regulators expected to certify that the 737 MAX 7 later this month. And trade policy, President Trump has delayed aircraft tariffs and increased directed negotiations with trading partners, reducing some near-term uncertainty for the aerospace sector. Consumers' behavior remains a mixed story. Grocery chains are aggressively cutting prices to attract shoppers who continue to look for value. Although that doesn't necessarily mean overall grocery bills are coming down, um, it is a little helpful there. And autos global EV demand is picking up again, helped by a strong demand in Europe. However, traditional markets, automakers continue to struggle in China, with both BMW and Volkswagen reporting weaker sales tied to softening demand in that market. What this means for our clients is that we're continuing to see highly selective economic environment. Companies tied to AI, aerospace, and parts of the EV supply chain are benefiting from strong secular trends, while businesses with significant China exposure continue to face headwinds across both public and private markets. Um, Selectivity remains very critical. And then that kind of leads us into our wealth wisdom workshop, where we're kind of stay focused on inflation, which is a silent threat that erodes retirement income year after year. And Marcus will lead us off there.
All righty. Yeah. So for today's Wealth Wisdom Workshop, let's talk about a retirement risk that doesn't get nearly as much attention as market crashes, taxes, or healthcare costs, but arguably does deserve more. It's inflation. And the reason inflation is so dangerous is because it's quiet. So, unlike a bear market, inflation doesn't make headlines every day. It doesn't send your account balance sharply lower overnight. Instead, it works slowly, consistently, and almost invisibly in the background. But over the course of a 25 or 30-year retirement, inflation can be one of the biggest threats to your long term financial security. The reality is that most retirees aren't worried about whether they can afford retirement in the first few years. The real question is whether they'll be able to maintain the same lifestyle 20 or 30 years down the road. And that's where inflation becomes such an important planning consideration.
hmm And so, why does inflation hit retirees differently? Inflation affects everyone, but retirees often feel the impact more than working households. That's because retirees typically spend a larger percentage on their budget on categories that tend to experience higher than average inflation, including things like healthcare, housing expenses, groceries, utilities. insurance premiums, and prescription medications. These aren't luxury purchases that can easily be postponed, they're necessities. So when prices rise in these areas, retirees tend to feel it immediately. At the same time, most retirees are living on fixed or semi-fixed income sources, or someone in their working years may receive raises, promotions, or bonuses that help offset higher costs. Retirees generally don't have that same flexibility. If expenses rise and income stays relatively flat, something has to give, and often it's lifestyle. That's one reason inflation is frequently called the silent thief. It gradually reduces purchasing power while account balances may appear unchanged.
So yeah, that power of compounding, that works both ways. So we're used to hearing about the
Mhm.
power of compound growth when it comes to investing, but inflation compounds too. At 3% annual inflation, the cost of living doubles roughly every 24 years. At 4% inflation, it doubles in about 18 years. Think about that for a moment. Many retirements today last 25 to 35 years. That means retirees could experience multiple periods where the cost of maintaining the same lifestyle dramatically increases. The retirement income that feels more adequate at age 65 may feel much tighter at age 80 and potentially insufficient at age 90. The challenge isn't necessarily surviving the first decade of retirement, it's protecting purchasing power throughout the later decades.
Mhm. Perhaps nowhere is inflation more visible than in healthcare. And for many retirees, healthcare represents one of the largest expenses that they'll face. And historically, healthcare costs have often risen past the overall inflation. Medical expenses, insurance premiums, long term care needs, prescription drugs, and specialized services can place increasing pressure on retirement income over time. Even when Social Security provides cost of living adjustments, those increases don't always fully offset the actual expenses many retirees experience. As a result, healthcare inflation can create a widening gap between income growth and spending needs. And because healthcare spending often increases with age, the impact can become even more significant later in retirement.
And inflation doesn't act alone. So, one of the most important
Hmm.
concepts to understand is that inflation rarely operates by itself. Instead, it magnifies other retirement risks. Higher living costs often lead to larger portfolio withdrawals. Larger withdrawals can increase the stress placed on investment portfolios. Inflation can also increase tax exposure, raise required income needs, and make longevity risk even more severe. Simply put, the longer you live, the greater the cumulative impact of inflation. That's why inflation isn't just one risk among many, it's a risk multiplier. It makes nearly every other retirement challenge more difficult to manage. So let's look at a quick real world example. Let's put some numbers around this. Imagine a retiree who needs $80,000 per year at age 65 to maintain their lifestyle. Assuming inflation averages 3% annually, that same lifestyle will require approximately $107,000 per year at age 85, $144,000 per year at age 85, $193,000 per year at age 95. Think about that. Without any change in lifestyle, the income needed nearly doubles over the course of retirement. That's often the part retirees underestimate. They're not spending more because they're living extravagantly. They're spending more simply because the cost of maintaining the same standard of living has increased. And if income doesn't keep pace, retirees may face difficult choices later in life when flexibility is often at its lowest.
Hmm. And then to where traditional retirement planning kind of falls short in this conversation is that many retirement plans are built around a few familiar assumptions: a diverse portfolio, a fixed withdrawal strategy, and then social security benefits, and the expectation that markets will generate net growth to offset inflation over time. The problem is that none of those approaches automatically create rising income. A fixed withdrawal strategy does not inherently increase and adjust to increasing expenses. Social Security cost of living adjustments may help, but they don't always reflect the real world inflation retirees experience. And hoping markets outperform inflation isn't an income strategy, it's an expectation. Successful retirement planning requires intentionally addressing how income will evolve over time, and not simply how much income is available on day one.
So, the key takeaway as we wrap up today's Wealth Wisdom Workshop, here's the big idea. Inflation is one of the most predictable risks retirees face, yet it's often one of the most underestimated. The greatest threat isn't running out of money next year, it's gradually losing purchasing power over decades. That's why retirement planning shouldn't focus solely on accumulating assets. It should also focus on creating an income strategy capable of adapting as the cost of living rises. Because retirement isn't just about reaching the finish line, it's about maintaining your lifestyle for the entire journey. That wraps up this week's podcast. We'll see everyone next week. Take care. Have a great week.